Joining us from Singapore is Arjuna Mahendran, Head of Investment Strategy for Asia at HSBC Private Bank. Good morning to you, Arjuna. Thanks for joining us.
Good morning. How are you?
Obviously, I'm good. Obviously, we're seeing some relief in markets across the world, but will it be a short-term relief?
Yes, I mean, it's one element of uncertainty that hopefully will be put to rest. But there are several other potential black swans, if you like, swirling around the place. We're still trying to and understand why the United States has nearly fallen off a cliff in terms of growth. Those dreadful first quarter growth numbers, I think, have shocked the markets. And clearly there's some sort of a mid-cycle slowdown going on, which can't fully be explained, I think, by the problems in Japan, which affected the global supply chain, and high oil prices. So I think until the markets have some further clarity on how this pans out, or whether corporate earnings for the rest of the year are going to reflect that fairly downbeat picture, that I think will continue to sort of keep the markets slightly tentative.
What about if Standard & Poor's reduces the AAA debt rating, which of course it's threatened to do because it might deem this agreement, if it gets through Congress, as insufficient?
Well, I mean, that's, I think, a longer-term issue. I think S&P would be very irresponsible if they were to do, downgrade the debt in the next week or so. I reckon it'll take another 2 to 3 months before even they can, get more clarity on how the overall economic cycle is unfolding in the United States. So I don't expect that as an imminent negative for the markets. But certainly, if the deal that comes out of the Congress is sort of half-baked and doesn't even remotely reach that magic 4 trillion number that the rating agencies have told us the U.S. needs to reduce in the next 10 years, that would also, I suppose, continue to keep markets slightly downbeat.
So, Arjuna, what's our strategy in the next couple of months? Because I know you're saying in August that you remain defensive.
Well, yes, we are defensive in August because of this issue and perhaps the continued uncertainty about how this European debt deal is going to pan out. The specifics are remarkably thin on the ground as how the Greek debt is going to be rescheduled. We'll have to watch how that pans out for the banks that hold that debt. But I think by September or so, we'll hopefully have a little more clarity once the earnings season in particular is over. Remember, a lot of Chinese companies are going to report earnings in August. And that will give us a picture of how the emerging markets, which have been fairly quiet over the last 6 months to a year, how that segment of financial markets will perform going forward. And that, I hope, will be a little more positive and upbeat than we've seen so far.
The big story closer to home, to where you are, is that China manufacturing number, manufacturing growth exceeding estimates. Does this tell us that the economy in China can withstand higher rates, can withstand tighter credit?
Well, what it's told us, from my perspective, is that China's successful in achieving a soft landing, which is absolutely critical because there are lots of hawks out there who've been telling us that China has got it all wrong and there's something nasty about to happen. I think the Chinese have managed this very well, and over the next 2 to 3 months we'll probably see the headline inflation number coming down, which will also be a source of encouragement. So I reckon you're going to probably see an inkling of decoupling over the next 6 months, where the emerging markets, because the rate hiking cycle is almost at an end, will start seeing more life, and perhaps the developed markets will be on a holding pattern until we have more clarity on U.S. growth.
Arjuna, thanks for joining us. We'll speak to you soon. Arjuna Mahendran, the Head of Investment Strategy for Asia at HSBC Private Bank.